Thank you so much for being with us today. We're supposed to have a great turnout. It looks like we're still going to probably be adding some people, and that is fine. My name is Quinn Hart, and I'm the partner in charge of our tax department here at Strothman and Company. And today you'll be hearing from members of what we call our technical tax group. And we also have some guest speakers today, and I will introduce all of them in just a moment. Before we dive in, a few housekeeping items. I always want to make sure that I thank Vince Kane and Jess England, our practice growth team, for helping us pull all of this together and keep things moving. If you need CPE for today, you need to answer all of the polling questions. There will be 5, and we'll try to point those out as they pop up so that you don't miss one. A recording of the presentation and the slides will be provided to all of the attendees. You'll probably notice a few things that we skip over in the slides just in the interest of time, but we wanted to leave that information in there so that you have it to refer back to once you get everything. Please keep your microphones muted during the presentation and keep your camera off if you're not one of the presenters. If you have questions, use the chat function and direct those questions to Vince Kane, and he'll make sure that they get to the right person. We'll address what we can here in this session if we have time. Whatever we don't address, we'll follow up with you on and make sure that we get you an answer. Looks like polling question 1 is up, which I totally ignored. Sorry about that. So make sure you get that in. Okay. So our tax group came into 2020 thinking this was going to be the first time in a few years that we didn't have new tax law to deal with, and we were very wrong about that. Fortunately, a lot of the changes earlier in the year were very taxpayer friendly, so they were good changes. We are having some challenges in dealing with the IRS on some of these changes, and we'll talk about that. So our goal today is to walk you through the basics for items that have changed this year and some changes that might be coming, and give you some reminders about some items that changed previously that are still fairly new and we want to make sure that you remember, and give you some ideas and tools for reducing your tax liability. So now I want to introduce you to our speakers for today, starting with the experts on the Strothman team. This is what we call our technical tax team. If you've attended many of our seminars before, you probably know Neil Zinzer. Neil is a partner in our Middletown office, and he's also the partner in charge of our emerging markets industry group. So you'll be hearing from him today. You heard from Wayne Elbert earlier in the year if you attended our manufacturing seminar. He's the tax representative for that team, and he's a senior manager in our tax group. And I also want to introduce you to Janet Koch. Janet came to us from a firm in Alabama with lots of years of tax experience. Ray Strothman calls Janet our Alabama office. He says we've opened an office in Alabama now. She's working for us remotely from there, and we're thrilled to have her on the team. She's never attended a Strothman and Company seminar before, so we didn't make her present today, but next time. But she did a lot of work behind the scenes for this one, and you'll be hearing from her in the future. So I wanted to make sure that I introduced her here today. We also have some guest speakers today, and I'll introduce them a little bit further when it's their time to speak. But we will have Estefania Quesnel and Kevin Corley from alliantgroup. We partner with them on a lot of research and development studies. And so they're going to talk to us about that today and look for some opportunities there. And finally, we have Karen Pope from Bedford with us today. And we work with Karen whenever we have clients that can benefit from a cost segregation study. So she's joining us today to walk through some details there. So we're going to start with the Strothman agenda. So these are the things that we're going to cover. It's a lot of information, so we're going to try to just keep it pretty high level and not get too detailed on you. Wayne is going to cover some general individual provisions, some of the normal year-end update things that we always share with you, plus some things that happened in the CARES Act. We're going to talk about PPP loans, the tax implications of those, at least what current law is, what we know at this time, and how to do some planning around that. Neil is going to talk to us about some QBI tax planning opportunities. QBI is that 20% qualified business income deduction that came in a couple years ago. And Neil is also going to cover some provisions in the Secure Act and then talk about what we know right now on the Biden tax plan, things that he proposed during the campaign. And then I will cover some additional provisions of the CARES Act that we haven't already covered. And then if we have time, we'll go through some new items for Kentucky state tax. So at this time, I am going to turn it over to Wayne to get us started on some individual tax provisions.
Glad to have you guys around. We'll get started with the general provisions for this year. First thing I'm going to start with is the tax rates for 2020. And, a couple things I noticed on here. Married filing joint is, double what it is for married filing separately through all the groups. One thing you do notice here, though, is it's double what it is for the single rates all the way through the 32% rate. But after that, it actually is not double what it is for the single rates. So obviously in the 35 and 37% brackets, you do still have an existing marriage penalty. Then we'll move into 2021. It looks like all the rates creep up about 0.8%, or all the brackets creep up about 0.8%. So if you're going to get any raises above that, there's going to be some bracket creep that becomes involved with that. The next thing we're going to talk about is capital gains rates. They're still at 0%, 15%, and 20%. Once again, it's double for the married filing joint that it is for married filing separately. But when you get into the single side, once again, you're going to have some marriage penalty involved on capital gains. As you notice, the single rates, beginning bracket starts at 441,000, 496,000 for married. So there's a little bit of marriage penalty there on the capital gain side of it also. Next thing is standard deductions. Those are the numbers for 2020 and 2021. Not much of a difference between the 2 years. It does creep up a little bit. The additional deduction for the elderly and the blind is $1,300 for 2020, $1,350 for 2021. And that is, can be doubled. If you're over 65 and blind, you get it twice. And the other item of note there is the additional for elderly or blind is $1,650 in the case of head of household versus the $1,300. Reminders from the itemized deductions from the prior year. Taxes, state and local income, property taxes limited to $10,000 once again. Itemized deductions that were subject to 2% of your AGI. Miscellaneous itemized deductions have been done away with. Casualty and theft losses only deductible in a federally declared disaster area, and the overall deduction limitation is still gone. We also talked about this last year. Mortgage interest deduction changed quite a bit. The interest, or the loan limits went from 1 million down to 750. There was a grandfather provision in there for loans originated prior to December 15, 2017. Home equity lines of credit still have to be to improve the house. Before, you used to have a little leeway in there where you could use, I think it was 100,000 for other than home mortgage or home improvements. There's some new rules as far as charitable contributions are concerned. The CARES Act now suspends the 60% adjusted gross income limitation, and instead allows up to 100% of AGI, but that's cash contributions only. You can't put into a donor advised fund and apply that to that for this year. And if you're taking the standard deduction, there is, I believe, an additional $300 you can take for charity to certain donees, which are basically, educational, charitable, religious organizations. Child tax credits, there they are this year, $2,000 for a qualifying child, phases out between 200 and 240,000 for singles, and double that for married. And for a child who is not a qualifying child, or a dependent that's not a qualifying child, for the $2,000 credit, you may get the $500 credit for them with the same phase outs. And what makes a child qualifying is they're 16 or less at the end of the year. Now, there is a new form 1099 NEC coming out this year. NEC meaning non-employee compensation. And what they've done is they've moved what was non-employee compensation, I believe box 7, off of the 1099 miscellaneous and moved it onto the 1099 NEC. On the 1099 NEC, you should include non-employee compensation and also any payments to attorneys that are for services they render to you. If you're in a business and in your trade or business, you contract the attorney to draw up some papers for you or whatever, that should also be reported on the 1099 NEC. The 1099 NEC has a due date of January 31st, so you'll have to get those out fairly early. The 1099 miscellaneous still does contain a box 10 for gross proceeds paid to an attorney. And I believe what this would be is if in the course of your business you get sued and as part of the settlement you have to pay out and then you write a check to the attorney, this is where you would report that, as opposed to what you pay him for, services for you. The due dates for the 1099 miscellaneous still remain February 28th. However, if you file them electronically, you've got until March 31st to get them filed. Tax implications of the PPP loans. The big thing going on out there right now is originally when this was all passed, Congress's intention was that this not be taxable income to the recipients once the loan is forgiven. Well, the IRS is looking at it otherwise, and they basically say if you get a PPP loan and it's forgiven, any of the expenses you pay with that loan are no longer deductible. And Neil will get into this a little bit later on when he talks about it and how it will affect possibly your Section 199A deductions. But the way we're looking at it right now, you've got several options. You can wait and see what they're going to do and possibly file an extension and hope that it's done by then, or you can file and not deduct the expenses. And if they change their mind, then you'll file an amended return at that time. And I think that is about it. And it's time for Neil to come up.
So I'll just mention quickly that, we're doing a lot of tax planning right now, and the PPP is obviously a big factor with that. And so most of the time when we're doing planning, we have at least 2 scenarios that we're looking at. So we're looking at assuming the PPP is taxable, assuming it's not taxable, maybe somewhere in between. Most of the time what we're doing is making sure that everybody's safe for penalty and interest. So you can use your prior year tax to make sure that you're safe. And then just planning around what could be due in April, since we don't know, we're hopeful that things are going to change. So technically we're saying we don't know what the law is yet, since we're hoping that there's going to be a change for the PPP, but we're just trying to make sure that everybody's prepared. So it's best to plan for the worst, but just pay in the minimum to avoid penalty and interest, make sure you're covered there, but just plan just in case there are no changes to those PPP rules. And we'll
and on that, hoping things will change, the current stimulus bills that are being thrown out there, they have mentioned that a revision are in those bills. The AICPA has stated, and other various articles I've seen, where the fix to include those expenses as being deductible are in these bipartisan bills that are being thrown around. Yesterday, they released some section by section summaries of the bill. They actually split the bill into two separate bills, one more of a stimulus for small businesses and one more for local aids, local or state and local aid. That's a big fight right now. But the only thing I'll just mention on the summaries of the bills, there was no fix listed in there. They did talk about extending more PPP loans, making those available for businesses hit harder. But the summary they did release yesterday did not include any fixes to our problem. So hopefully that summary is just a summary, and the details of that will come out at some point. So we're still hoping. All right, so we're gonna go over some planning opportunities for qualified business income deduction. Since 2018, we've been 2 years calculating QBI deductions for everyone. And so we're not gonna go through the calculations and what qualifies as income, things like that, but kind of go over some of the items that we can do to maximize our QBI. So one of the big easiest things is aggregation planning. Taxpayers that own two businesses, have two separate qualifying trader businesses, have the option to combine those two for qualified business income purposes. And what this does, it allows one entity to use the wages and qualifying property of the other to maximize their qualified business income deduction. The limitations are set on, essentially the maximum, the lesser of 20% of your qualified business income, or 50% of your wages, or 25% of the qualifying property. Sometimes a business may have high income but low wages, and that entity is subject to a lower deduction because their wages are limiting their higher QBI. So here, if we aggregate, I have one operating entity that has pretty good sized income, but essentially no wages, no qualifying property for whatever reason. And the owner of that entity owns another entity to where that company has qualified business income with higher wages and higher property values. So what this owner can do at their individual tax return level is essentially elect to aggregate those two entities to where the qualifying business income of both entities are combined, and the wages from one entity are used to increase the deduction for the other entity with lower wages. Things to note on this aggregation: it is an election that is made at the owner level for each entity that qualifies the aggregation test, which I'll briefly go over in a minute. But one thing to think of too is that once this election is made, it is binding. You cannot elect out at a later date unless facts and circumstances change. So if one business is sold, then the election is gone and you don't have to aggregate anymore. So it's definitely an item to look at. Some of the most common aggregations that I've seen is when I have an operating entity and a rental unit with the same owner, and it's a self-rental. So pretty much by default, I can aggregate those two. Normally, the operating entity has enough wages to cover the rental income of the rental unit, and my QBI is qualified business income deduction is increased based on the wages of the larger entity. Once you make the election, new entities can be added to that group, but again, you cannot remove any entities once the election is made unless there is a sale. There are multiple requirements that need to be met in order to qualify for aggregation. I'm not going to go over each one, but the main important one, one of the important ones, 50% ownership group. As long as there's a 50% combined ownership between the two entities, you can aggregate. It has to be majority of the year. And one of the biggest items, they have to satisfy at least two of these following factors. They must provide products and services that are the same or customarily offered together. They share facilities or significant centralized business elements such as personnel, accounting, legal, manufacturing, IT, and they are operated in coordination with the reliance on one or more of the businesses in the aggregated group. So a lot of times what happens, you have two entities which kind of operate separate trades or businesses, but same ownership group and kind of same internal accounting structure, IT structure, and legal. Everybody's operating the same. One entity. The internal structure is running both trades or businesses. So there's an easy way to aggregate and meet those two tests. Things to think about, like I mentioned, is it beneficial for the current year? Will the facts and circumstances be similar going forward? And then would all the businesses under the potential election use the same factors for determining the deduction? If it comes to where I have enough property to create my QBI deduction in one entity and enough wages in the other, I don't want to aggregate. You don't want to aggregate unless you absolutely have to take that deduction. I got to know here, is there potential negative QBI? There possibly could be, but if I have a loss from one qualified business, trader business, that loss will offset my qualified business income of the other, whether they're aggregated or not. And any overall loss for the year, any overall QBI loss from the year is carried over. So in that instance, the loss, whether aggregated or not, is going to affect both businesses. So another limitation that we hit is wages. Like I mentioned earlier, you need a certain amount of wages to benefit fully from the qualified business income deduction. So normally wages are items paid through W-2s, paid to employees through a common payroll provider, amounts paid to owners of an S Corp. So all those qualify as wages for calculating the QBI limitation. What are not wages are 1099 miscellaneous for contractors, sole proprietors. They're not allowed to pay themselves a wage. So even if you issue a W-2 to yourself as a sole proprietor, Schedule C filer, that would not count because you're not technically supposed to file a W-2 for yourself. Guaranteed payments to partners are not wages either, nor are partners in a partnership that pay themselves a W-2. So a lot of times, some partnerships, the partner owner works within the business and they'll put themselves on payroll and include themselves, get a W-2 at the end of the year. Technically, that is not allowed, and those wages will not be allowed for calculating the QBI wages. One thing Wayne mentioned was about how the PPP loan might affect this. So another item that is not wages, based on the rules and regulations of QBI, are wages not included in the calculation of qualified business income are not allowed when calculating the 50% threshold. So what this means for the deduction in PPP loans is the wages I used, the funds from the PPP loan were most likely used to pay for employees. That was the main purpose, to keep employees working. Now, what the IRS has said, up to what you expect to have forgiven, those wages will not be deductible on your tax return. So what would happen in this instance is that on my tax return, I would have to decrease my wages, increase my taxable income, thus increasing my qualified business income. And what that means is those wages, since they were not used in calculating QBI, I cannot use that as my limitation wages. So there's not a lot of guidance out there. We haven't seen anything specifically relating these two topics together issued by the IRS. But if you read the letter of the law and the instructions for the QBI form, that line item is troubling. So there could be an instance where your QBI deduction is affected based on the amount of non-deductible wages you have to report because your PPP loan was forgiven. So hopefully when Congress fixed the deduction, we won't have to worry about it. If your business has enough wages, $1 million more wages than your PPP loan, you might be fine, but there could be a sweet spot to where people are affected by this. So that would be something you want to talk with your tax planner about, just to make sure you're taking that into account for your QBI. So we talked about things that are not wages. We can talk about some opportunities to where we can increase our QBI deduction when we don't have any wages. Here's a quick example of a way to create wages for members of an LLC. This is a structure where I have 3 partners in an LLC that essentially work within the business. 2 of them are normally paid guaranteed payments. And like we said before, guaranteed payments are not allowed for calculating the wage limitation. Some planning opportunities that you can do is set up a separate schedule or S corporation and operate a management company. You'll see here with the, here's the LLC, and I just set up a separate S corp to where I start paying 2 of the partners to manage the S corp while they're managing the partnership. So what happens here is wages are paid to an S corp owner, and those wages can be used for QBI purposes. And then with the ownership group here, I can most likely aggregate those 2 businesses and have enough wages to bring the QBI deduction at max value. Another opportunity, again, partnerships, wages are sometimes low in the partnerships. There's an indirect way to kind of structure it to where I can pay the owners of the partnership as employees by setting up single member LLCs that actually own the partnership. This is more kind of aggressive stance, and it may not even, the IRS may push back on this one, but again, the ownership structure allows separate entity, and I'm not essentially paying the owners guaranteed payments anymore. I'm paying employees. So you'll see Pete and Johnny, they'll become employees of the operating partnership, and the wages to them will qualify for the deduction. So an instance where we have some guaranteed payments, again, here's a quick example showing the operations of a partnership, gross income, guaranteed payments. My qualified business income sitting at $300,000, and the tentative deduction is $60,000. In one of the partnership situation, his income is his share of the partnership income plus his guaranteed payment. This QBI deduction is really only 20% of essentially the $100,000 of the partnership income. Now, if we choose not to make guaranteed payments to these partners and make distributions based on capital, we can get rid of the guaranteed payments and fully take on our QBI deduction just based on the income by not decreasing our taxable income. Now, in instances like these, you have to worry about operating agreements, making sure everybody is comfortable not getting the guaranteed payments, instead basing it based on profits and losses. And there's always the issue of disguised guaranteed payments. So like I said here, things on the guaranteed payments, disguised guaranteed payment, the IRS could come in and say, no, you're really just doing a guaranteed payment. And that'd be where it's key to keep your operating agreements in line to make sure we're not using any language that would appear to be guaranteed payments. One of the things is, do I have to pay reasonable compensation to a partner working within the partnership? That answer is no. That reasonable comp rule is limited to the S Corp shareholder employees, and the IRS has come out and stated that for the QBI regulations. Okay, all right. So for QBI, one other thing I did want to mention for that was, the partnerships, like I said, guaranteed payments, the wages are limited. Another opportunity is to convert that to an S Corp. That is where you have to pay wages to your owners, and those wages will qualify, but you just have to be careful when converting to an S Corp and watch out the tax implications for that. All right, the Secure Act was signed into law last year as part of the Appropriations Act. So these were some changes to some retirement plans. One of the big things was increasing the RMD age from 70 and a half to 72. If you were going to turn 70 and a half in 2020, normally you're just going to have to start taking your required minimum distributions out of your IRA. They changed that to now the limitation is 72. So anybody taking that this year got a reprieve for 2 more years and got to build their assets in the investment accounts. One note, part of the CARES Act, the 2020, out of the way. 2020 CARES Act, they waived the RMD requirement for that year, to where anybody taking RMDs, they did not have to take out that money this year. So one thing to think about before year end, if you've still been taking your required minimum distributions and you don't really need that cash at the moment, there's still the 60-day rollover option to where you can put that money back into your account and not have those amounts taxable. So anything received with 60 days has the option to roll that over and put that back into an investment and not be taxed on that income. The age limitation for IRA contributions was removed. Previously, anybody over 72 were not allowed to contribute to an IRA. With more people working up into their 60s and 70s, they have removed that limitation. That was effective for 2020. There's a credit for people, eligible employers creating a plan. The original credit was $500 or half of the plan cost. Now it is up to $5,000 tax credit. And that is any new plans starting in 2020 and after. 401k plans normally had to be set up by year end. They've extended that due date to tax return due date. So as a tax planning tool, what you can do is set up a retirement plan, 401k plan to make contributions and decrease taxable income. Okay. One thing starting in 2021 is now any long-term part-time workers are required to be included in an employer-sponsored plan. The whole part of the Secure Act was to make retirement plans more accessible to individuals. So this requirement to make any part-time workers eligible for plans was a big deal. So the limitations, the qualified employee is anybody that's worked more than 500 hours, but less than 1,000 hours per year for 3 consecutive years. This is anybody starting after 2020. So starting in 2021, you're going to look at some of your part-time employees and see if they are eligible for inclusion in their retirement plan. Another big thing that was on the Secure Act, there was a shortened distribution period for non-spouse inherited IRAs to a 10-year maximum. Before, it was based on the plan at date of death or discretionary of the beneficiary, but now they have made sure that you have to take that out within 10 years. There are certain exclusions. If a spouse inherited the IRA, there's no limitation based on regular plan years, and other exceptions related to disabled individuals and government plans. So some other things in the Secure Act, just things to be watching out for with your retirement plans, and talk to your plan sponsors. All right, so seems like yesterday, or I guess it was yesterday, that the electoral process has ended and Biden will be the president. So he's had some strong tax plans coming out with very little details of how some of those are going to go in. So his whole plan is to, tax the rich and remove certain tax benefits for those people. So first rate is increase the rates from 37% to 39.6% with individuals making taxable income over $400,000. So 39.6 was the previous max rate before it was reduced by the Tax Cut and Jobs Act. And that rate was, 37% rate was set to expire in 2025, but Biden may push those dates up by increasing the rates before the 2025. Another rate increase is for the corporate tax rate. Right now it's at 21, it's going to go to 28%. Another item that he's thrown in there is a 15% minimum tax on book income for corporations reporting $100 million of profits in the US that are paying zero tax. So Not a lot of details have been given in as what it means. What is book income? Is that going to be based on your audited financial statements? No one's really sure. No details have been given. What this will be is essentially an alternative minimum tax type, where anybody with book income and paying zero taxes based on investment credits, foreign tax credits, and any other type of credits where they're essentially paying zero tax. So you think of the Amazons where they're paying zero tax, but this huge company making billions of dollars. So he wants to get those people's fair share of taxes coming. But again, details on what constitutes book income, how it's all going to work, it's not out there yet. Another big item that has people concerned that if people earning over $1 million, their capital gains and dividends will be taxed at the top income tax rate for individuals. As Wayne went over the capital gain rates earlier, they were from 0 to 20% at certain income levels. Again, details of is the $1 million taxable income, is it adjusted gross income, or is it anything over $1 million is tops at the top tax rate? We're not sure. Not a lot of details are given. Currently, the income thresholds are based on taxable income, so they seem to believe it would just carry over, and the income limitations would just be an increase and the rates increase. And but again, until it's all hammered out within legislation, no one really knows. But this is an item to be thinking of, depending on how the Senate comes out. If this one gets passed, normally what we'll tell you to do is defer income. This may be some time to pick up income in the current year. So any big gains coming up may behoove you to get that done before year end, just in case there's a higher tax rate next year. Biden's also wanting to increase some dependent care credits and a child tax credit for qualifying families. Again, not really too many details on what that means. He wants to remove the cap on the state and local income taxes. So removing that $10,000 limitation on your Schedule A is in his plan. But then he's going to start capping itemized deductions for certain individuals at a 28% of income. He's also going to bring back the PEAS limitation for an overall cap on an overall limitation for your Schedule A itemized deductions. Anybody making over $400,000, he's going to implement a new an increase in Social Security taxes. Currently, individuals with their wages over a certain amount of money, they stop paying Social Security taxes. So what he wants to do is anybody that steps over $400,000, the Social Security tax is going to kick back in. So, anybody in between the current limitation between $400,000, they essentially call it a donut hole of Social Security taxes. So that's going to be an implication as well. And you see his $400,000 income amount, that's where he's, hitting people with these new laws and limitations, where he's wanting to make sure these people at that level are being taxed. And also mentioned that the employers would be subject to that additional tax as well. So something to start thinking about and planning. He wants to increase the manufacturing distribution in the U.S., keep jobs here. So he's going to expand a new market tax credit and work opportunity tax credits, create additional manufacturing credits and job creations in the U.S. Wants to start up new first time home buyer credit and distressed area revitalization. One thing, he wants to start limiting qualified business income deduction for individuals making over $400,000 and start limiting real estate investors on some of their tax loopholes, is what we'll call, of decreasing their income. So again, not a lot of details there. Some are speculating that it will be regulating like-kind exchanges and not being able to take advantage of those. Some other things, raising the GILTI tax from 10 to 20 or 10.5 to 21%. That'll just kind of go in line with corporate income tax rate. And then another big thing is eliminating the stepped up basis rules for transfer of assets after death. So that is a big one where he's essentially eliminating a very large tax break for individuals inheriting assets from a dead relative. So that one's always kind of been a plan of the Obama administration. So he's kind of carrying that over. But again, no details are out there. All speculate, just waiting to hear. And once he gets in office, we'll see how things start going. I'm going to hand it over to Quinn to go over some CARES Act.
Thanks, Neil. Yeah, so as we get more information on Biden tax plan, as things start happening, we'll send out alerts, we'll do more seminars, we'll keep you guys up to date. We didn't want to spend a ton of time on it today just because we don't know what's really going to happen or when it's going to happen. I wanted to mention a couple of other things about the PPP. We keep coming back to that, but I know that's a big topic and it's on a lot of people's minds right now. I've talked with a couple of clients who are saying that as they're applying for forgiveness, the bank that they're going through is encouraging them to use wages as all of their expenses for forgiveness. And they're doing that because you have to provide documentation on the expenses. And that's the easiest thing to provide documentation on because you have your 941s, your payroll tax returns, you can easily provide that. But as Wayne and Neil both pointed out, if you use all of your PPP for wages, that could affect your qualified business income deduction. So think through that before you provide that documentation. If you haven't done that already, get with us if you have questions on that. I don't know that the bankers are thinking about some of the tax implications as far as the QBI. They're just trying to do what's easiest and best for you from their perspective for the forgiveness, but that's something to think about. And then I also wanted to mention, I don't know if we made it clear, again, the IRS's stance is that if you expect that your loan is going to be forgiven, even if it's not technically forgiven in 2020, the expenses paid in 2020, at least under current law, are not deductible. So, a lot of this time we've been thinking, well, maybe it's based on when a loan is forgiven, so nothing happens until 2021, but that's not the case. So I wanted to make that clear. Okay, I'm going to dig into some other items on the CARES Act. Okay, we've used this slide in a few seminars this year, but I think it's helpful for the net operating loss rules to kind of see where we came from to understand how we got to where we are now. So we're going to go back to before the Tax Cuts and Jobs Act. So the old NOL rules, there was a 2-year carryback period. So if you had a loss, but you had income in the previous 2 years, you could carry your loss back and get a refund of some of those taxes paid in earlier years. And then there's a 20-year carry forward. So if you chose not to carry it back, or you carried it back and you still had some left over, you could take it forward for 20 years and offset income in future years. And then under old law, you could offset up to 100% of your income, depending on how much your loss was. When we had the Tax Cuts and Jobs Act pass in 2017, they took away the carryback, so you could not carry your loss back, only forward, but you could carry it forward indefinitely, so there was no limit there. However, you could only offset 80% of your taxable income. So no matter how big your loss was, you wouldn't be able to offset everything. You'd have to carry the remainder forward. So when the CARES Act came out, we got kind of a combination of those two laws. So they said for 18, 19, and 20, you can fully offset taxable income if your loss is large enough. So there's no 80% limitation for those years. And then instead of the old 2-year carryback, we get a 5-year carryback for losses arising in those years. But there's still an indefinite carry forward. So they let you go back 5 and then you can still carry anything that's left, or again, choose not to carry back and carry everything forward. So when we talk about the net operating loss rules, we're talking about individuals and C corporations. For C corporations, be careful if you have alternative minimum tax in a previous year that you're carrying back to. You can still get make that part of your carryback and get some of that tax refunded, but there are some additional elections and statements you have to make with that carryback return. So be careful with that. The problem we're having right now is that the IRS, it seems like the IRS does not want to approve these things. I have filed several carrybacks for C corporations, and I haven't had any of them accepted yet. So we're getting a lot of notices saying that they were filed late when they clearly were not filed late. We're getting notices that our numbers don't agree to their records. And in the cases that I've seen, their records have not been accurate. If you had an amended return or a previous NOL carryback, it appears that they're not accounting for those. And typically when the IRS disagrees with you, they'll send a proposed adjustment, and that's not what they're doing right now. They are disqualifying the filing. So we have called on a lot of these. We've talked to people, we've sent information. We're waiting the very long amount of time it takes for them to process paper. We're not having a lot of success with these, but we're going to keep trying. The good news is in most cases, although the original point was to get people some cash back in 2020, which was a bad year for a lot of people, obviously, that was the whole point. It's not happening. But in most cases, that doesn't mean you're going to lose anything. If they disqualify the carryback, you can generally still carry it forward. There's probably a difference in the tax rates. So you might get a little bit more benefit carrying it back, but you know, it's not the end of the world if we can't get these things accepted, but it's very frustrating. But we're still working on those, and hopeful that we're going to get those to go through. Excess loss limitations. This is something else that came in under the Tax Cuts and Jobs Act. So previously, if you had a loss from one business, you can only offset a certain amount of other income. And that was $250,000 for single taxpayers and $500,000 for married filing joint. When the CARES Act came out, it retroactively got rid of that limitation. So that doesn't apply anymore. It does still apply for Kentucky. But for federal, if you were limited in 18 or you filed your 19 return before this law was passed, you can go back and file amended returns and adjust and potentially get a refund if your losses were limited. I want to say a few things about depreciation. Most of this is a reminder. A lot of it's not new. Bonus depreciation. Previously, the law that passed was that you could take 100% bonus depreciation for assets placed in service after September 27th, 2017 and before January 1st of 2023. And after that, the bonus depreciation is set to start phasing out and go away after 2026. This probably won't happen. We don't know for sure, but that's the current law. Most of the time, bonus depreciation is something that was getting extended every year. It's really good for businesses to be able to write off these assets. So it's not something that's going to go away without a fight. Just generally, bonus depreciation is for assets that are with a useful life of 20 years or less. Excuse me. When the Tax Cuts and Jobs Act passed, they got rid of the requirement that the original use of the property had to be with the taxpayer. So we used to only be able to take bonus depreciation on new assets, but that rule is gone now. So you can take it on used assets as well. Just be careful about who owned the asset previously. If it was a related entity or another related party, then you might not be eligible for bonus. The Tax Cuts and Jobs Act also was trying to simplify things with improvement property and trying to give taxpayers a benefit there. But there was an error in the way it was written that did not allow taxpayers to take bonus depreciation on improvement property, which was the point. So thankfully, the CARES Act corrected that. We had to wait 3 years almost for a correction on that, but the CARES Act did fix that. So you're allowed now to take bonus depreciation and 15-year life on qualified improvement property. Qualified improvement property, this isn't new, but the interior portion of a building, non-residential, placed in service after the building, and it doesn't include enlargement, elevator, escalator, things like that. This will be relevant maybe to some people if you have a fiscal year So you haven't filed your 19 return yet. There are some quirky rules around how to correct this. If you had 2018 where you had improvements that you weren't able to use the new law, if you are changing 2018 to take bonus on some improvements, if you have not filed your 19 return yet, then you can file an amended return for 18. But if you have filed 19, which calendar year, hopefully you have by now, if you have filed 19, you can't amend your 18 to make this change because you've spent 2 years under this rule. So you've essentially adopted an accounting method. So that means if you filed your 19 return and you need to amend 18, you actually have to do a change in accounting method versus just an amended return. We also still have section 179 depreciation if there are items that are not eligible for bonus. Those limitations have changed slightly. So the deduction for 2020 is limited to $1,040,000, and for 2021 it's $1,050,000. And then there's an investment limitation on section 179. So once you get to $2,590,000 in assets placed in service, your deduction starts to phase out. And then that number is about 2.6 million for 2021. Qualifying property for 179, a lot of it is the same as what qualifies for bonus, but then you also get roofs, HVAC, security, fire and alarm systems. That's fairly new. You can take 179 generally on those items. The business interest expense limitation, we could probably spend an entire day seminar on this. So we're just going to hit this really lightly. This is generally when it passed under the Tax Cuts and Jobs Act, it limited your interest deduction to 30% of your adjusted taxable income. So adjusted taxable income implies that there are several adjustments in there. It's not your actual taxable income. There are several things that go into that calculation. The CARES Act changed that amount to 50% limitation. So essentially that gives you a higher threshold to be able to deduct your interest expense. The other good thing they put in was that if you have lower income in 2020, you can elect to use your 2019 adjusted taxable income versus 2020. So that will get you a higher deduction. Really quickly, there are some payroll provisions under the CARES Act that are helpful. Most of these are about to expire. They're for wages through the end of 2020, but we wanted to mention them just in case you are doing your own payroll and you haven't seen these or your payroll company hasn't mentioned them. Hopefully they have, but the payroll tax payment extension and then the employee retention credit, again, those are for wages through the end of the year, but if that's not something that you've taken advantage of, you want to take a look at that. There is a waiver of the 10% early withdrawal penalty this year for any distributions that you took before age 59 and a half, if they're related to COVID. So if you were diagnosed or your spouse or dependent is diagnosed, or if you've had significant financial consequences due to COVID, if you take an early distribution, you'll still pay tax on that amount, but you won't be subject to the penalty. In addition to that, if you took a distribution for COVID-related reasons, you can elect to pick that up over 3 years in your taxable income, or you can elect to repay it over 3 years and undo the tax consequences. I am out of time, but just very quickly, a few things on Kentucky. There's polling question number 3, so don't miss that. Get that answered. Kentucky does not follow the provisions of the CARES Act. So the NOL rules that we talked about, the excess loss limitations, all of those still apply for Kentucky. And unfortunately, Kentucky is following the PPP loan forgiveness guidance from the IRS. So Kentucky's kind of the worst options. They don't have the benefits of the CARES Act, but they do subject you to the same rules for the PPP. Increase in 179 for Kentucky purposes, the deduction is now 100,000 versus 25,000, and the investment limitation is 400 versus 200,000. There's an inventory tax credit on Kentucky that increased to 75% for this year and 100% for 2021. And then also there's a rule that if your the fair market value of your assets is under $1,000, you don't have to file property tax returns. Quickly, there's our contact info. We'll put everything, you'll get all of this information, but we can put our contact information into the chat if that would be helpful. I have not seen any questions come through. So I think we'll go ahead and take a break, and then we'll check and see if we had any questions, and we'll try to address those in a bit. We're a little short on time, so we're going to try to keep it to a 5-minute break. So if everybody can come back in about 5 minutes, we will get started with our guest speakers. Thanks so much. So I want to introduce our next speakers, Estefania Quesnel and Kevin Corley from Alliant Group. Estefania, or Estef as we often call her, is the Senior Director of Strategic Relations with Alliant Group. I thought this number in her bio was pretty impressive, so I wanted to mention it. She has identified over $574 million in tax credits and incentives across 1,200 US businesses. That's crazy. Kevin is the Senior Marketing Director with Alliant Group, and he's also responsible for helping clients benefit from millions of dollars of credits, working with several of the top 100 largest CPA firms to help maximize their clients' tax incentives. So I'm going to hand it over to Estef and Kevin to talk to us about R&D.
Thank you so much. Good morning, everyone. Thanks for joining us. This is a little surreal in terms of what we're doing today. So used to being able to be there in person. So when it's joining live, I just wanted to throw it out there. Kevin and I have been working together with Strothman and Company for almost 14 years, helping them bring these value-added incentives that can help their clients not only realize some immediate cash savings, but also recover some taxes paid in prior years. So whether or not you're working with Strothman and Company and you feel like this is something that could apply to you, they certainly can help you understand whether or not this would make sense for you to take on a current year basis on an amended return. I don't know how many of you have heard of Alliant Group, and I can't see a show of hands, but I'm hoping that a few of you have, and others who may have not or have heard of Alliant Group but never explored the credit can either reach out to Strothman or Alliant Group to learn a little bit more. Just going to give a quick introduction to who we are. As mentioned, Kevin is a Senior Managing Director. He's actually one of our founders here at Alliant Group and has helped us grow our practice to where we are today. Kevin came from public accounting background, but has been delving in this space for over 18 years now. Myself, I've been with Alliant Group for 15 years, and I pride myself in building relationships throughout the country with CPA firms like Strothman, as well as industry partnerships to educate them on these incentives that can impact the bottom line of their clients and peers. As a whole, here at Alliant Group, just this year alone, we crossed the bridge of helping put back over $10 billion into the American US economy. We've completed over 50,000 studies across 30,000 US businesses and partnering with over 4,000 accounting firms. And it's a really exciting number, especially during these trying times, because a lot of businesses in the past have been paying taxes and, running their business day to day. But unfortunately, today, there's been a little bit of a halt or a jolt in our economy. And these credits can be recovered in prior years, which Kevin can talk a little bit more about later on in the presentation. You guys will recognize a few of these individuals, especially during the elections this year. So this is our Strategic Advisory Board. And basically, these individuals have come together to not only help educate business owners like yourself, but also to make sure that you guys are, knowledgeable of recent legislative changes, case law that has come out that have empowered these credits. In fact, the gentleman in the middle on the left-hand side, Dean Zerby, and to his right, Don Levy, were part of the Senate Finance Committee when the R&D changes were first proposed back in 2001 and finalized in 2003. So both senior counsels to the Senate Finance Committee under Grassley and Baucus, helping bring a lot of knowledge and understanding as to Congress's intent and why the R&D credit was modified from its original version, which Kevin will talk about. We're also led by 3 former IRS commissioners, Mark Everson was known as the enforcer. He was known as commissioner from 03 to 07. The joining of Mark Everson to our firm required that us start a quality control team, which allows us to build the gap between implementation in industry and enforcement. So all of our studies undergo 3 quality control reviews to make sure that everything is within the letter of the law. So Mark actually and Steve oversee that quality control process, and Kathy Petrovchik as well. What is unique about our firm, and I don't know if you guys know this, when I joined, we were about 50 employees, and it's really exciting. It's been 15 years that we've grown into over 1,000 employees. And although we have CPAs and tax attorneys like Kevin, the lion's share of our employees are industry by background. So we have individuals that understand the construction world, the software building automation world, where we have software developers, engineers, chemists, construction management, architects, engineers, PhDs, et cetera. So individuals that understand the various industries that we serve, marrying that back to the tax code by having individuals from a legislative perspective like Don and Dean, and then ultimately having a quality control layer to be able to maximize these credits and document and support them, which Kevin can talk a little bit more later on today. As a whole, that is a little bit about our firm. Hope that was exciting for everyone to learn a little bit about Alliant Group, but I'll hand it off to Kevin to talk a little bit more about the technical specifications of the credit and what are some of the recent regulatory changes that are impacting small and mid-sized businesses today.
Yeah, thanks everybody. I appreciate it. Yeah. With the R&D credit, I'm sure you guys already know a tax credit's a dollar for dollar reduction in taxes, not a deduction. A lot of people look at it and think there's a deduction element out there. It's an actual dollar for dollar offset against taxes. So meaning whenever year-end or tax time comes, you know, we can do what we always do, figure out your books and records, look for your write-offs, look for your deductions. But whenever taxes are owed, we use cash to pay it, either out of our paychecks or maybe write a check. But nonetheless, we all have understood since our first job out of high school, probably, that cash is used to pay taxes, but so are credit. So always important to kind of look at that. And even when I was in public accounting and I spent over 14 and a half years in that field, I was a tax partner at my firm when I left. Companies were always looking for other incentives. What else is there I can do? What else do you see? What else can I possibly take? And certainly this R&D credit, I think, fits in well with that. So the credit, again, dollar for dollar reduction in taxes and so forth. And we can go to the next slide, next 2 slides actually, and talk about the program itself. Yeah, right there. The tax credit, just for a minute, again, it's called the Research and Development Tax Credit. And the tax credit actually originated, Section 41 of the code, it actually originated back in 1981. So long story short, from 1981 till about 2004 or so, or 2003, basically all the 80s, all the 90s, and well into the 2000s, the R&D credit was static and did not change. And the rule behind it, again, the old rules were to put a patent on the wall. It was called a discovery test. And literally it meant that the company, in order to take an R&D credit during the 80s, 90s, and 2000s, had to discover something new. And the IRS came back and said, well, if you did discover something new, we should see a nice, pretty patent on the wall. So if we were in the 80s, 90s, or 2000s, which we were most certainly not, but if we were, we come back and, say, hey, do you have a patent? And if a company said no, we'd be done. Well, Congress looked at the credit after all those years, and they wanted to know who is taking advantage of this R&D credit. And I don't think it takes a rocket scientist to figure out what they found out, but they studied all the data for 25 plus years of who was taking it and what companies were benefiting. And as you can imagine, having patents being the benchmark behind the whole program, it was largely the Fortune 1000. It was the Boeings, the Apples, the Lockheeds, the GEs, the Pfizers, you name it. It was the Fortune. And think about all the clients you have served or work in or have ever walked in the door. We needed patents on the wall, not just one from 14 years ago, but we needed 12 new ones a year. That was kind of the volume that you would need. So Congress said, we need to reward every company that is taking advantage of the credit. More companies with us, specifically manufacturers, software companies, engineers, several other industries, which we'll get into. So what they did with the credit was make changes to it. And at last count, there's been close to 40 changes with the credit. So for the first 25 years, there was no changes, patents, period, end of story. Now there's been a whole lot of changes, and 2 or 3 a year, it seems. And by the way, every change that has occurred since December of 03 has been to advance the credit, improve the credit, better the credit, increase the credit. Not a single change is taking it back. But to kind of go through, you know, I'm not going to go through all 40 changes. We'd be here for hours, but we can go through the first one or two to kind of understand the credit. The first thing Congress did with this R&D credit in order to have more companies benefit is completely remove the patent requirement. So that stringent rule we had to follow for all those years is dead and gone. And secondly, they changed it all to applying and using the knowledge in the marketplace, applying and using manufacturing concepts, applying and using design principles, applying and using engineering concepts, applying and using software techniques and others. So it's applying and using. So that's a 180-degree pivot from where it was. Because again, it used to have to be new to the world, discoveries, patents. Now it just has to be new or improved to the taxpayer. It doesn't matter what the rest of the world's doing, what the other companies around you are doing. If it's a new product or a new process or a new software or an improvement, that is what it is. And this matrix that we have in front of us is a great example to kind of think through. And as Estefania and I talk to clients, we'll usually reference this particular slide or at least this. But if you look down and just think about, just for concept reason, a manufacturer. Now, it applies way beyond manufacturers, but I think we all understand a manufacturing company. And the manufacturer is a lot of products that they may make, whether it be for their own selves or for others, and processes as well too, and maybe software. But on the manufacturing side, to use an example, if they spent time and effort and money and resources and dollars trying to work on at the top the functionality of the product, or the performance of it, or the reliability, or the quality, or even the durability. So again, we don't need all of these boxes checked. You can have one. So if a company spent time and effort trying to improve the quality of their product, they could qualify for R&D credits. Or let's say they spent time to try to improve the reliability of the product, that could qualify. Or the process. The better performing process like ISO certification or Six Sigma or Lean or Kaizen, or maybe just less waste, less scrap, less spoilage, more efficiencies. So anywhere in this box would qualify. Even on the software side, you might have a company writing software or modifying software, you know, better functionality of the software, you know, better performance of it, underlying algorithms. And so as Estefania and I talk to companies, you know, a lot of times the conversation goes, I'm not doing R&D, because they'll immediately kind of gravitate towards patents and lab coats and university work and the rest, which is natural and normal for people to think through. When you say the words research and development tax credit, that's where a lot of folks are going to kind of start thinking. But you come back and say, well, that was the rule, but the rules today are product improvements, product betterments, changes in what you're doing. And the changes from companies can come from the marketplace, you know, wanting a different size, shape, dimension, different software, different engineered product. It can come from the competition. Our products are better, longer lasting, more durable, you know, more functional. It could come from internal changes. You know, sometimes internally you might take a manual process to an automated one, or you might go back and bring on an engineer or a software developer or a IT person to help solidify some of the aspects of the business, or even regulatory. OSHA could come in, the EPA could come in, another governmental body or state body could come in and say, you can't do it that way anymore. We've got to have protection on this, or it's got to be a green product, or it's got to be whatever. But the bottom line is companies are constantly and regularly dealing with changes in the business. And this credit is to reward them for the changes that they are dealing with, accepting, not accepting. They don't have to make all the changes, but really this name R&D, research and development, is a holdover from 1981, and that's it. It has no relevant value in that. And one last comment, then I will talk about the expenses here, is the way a business would not qualify. Sometimes I think it's easier to talk from the opposite end of the spectrum for a moment. For a manufacturer, for instance, to not qualify is they would have to be making the same exact product, the same exact way, with the same exact procedures, same exact people. In other words, if they had a time machine, could go back in time 3 or 4 or 5 years, you wouldn't see a thing different. It's like Henry Ford in the Model T, or, you know, making paper clips or nuts or bolts or something. But most companies are not in that space. It seems like every time they're having to change what they're doing, adapt to the marketplace, you know, work on different procedures and the rest. So This credit is pretty poorly named, I think, but if you kind of dig below the surface, you'll find a lot of great eligibility for the credit. And as Estefania mentioned earlier, with the $10 billion that we've helped companies with, if we applied the old rules, patents and lab coats, we would have $10 billion of credits that we found for our clients. We probably have about 10,000. So that's how expansive this thing has become. The expenses behind a credit, there are really three expenses that drive a credit. We have them up here: wages, and it could be from the owner of the business down to the bottom, back up to the top. But wages will drive the credit, including partnership earnings subject to self-employment tax, guaranteed payments. We talked about that a little earlier. Schedule C bottom line. So we can take wages, and this includes not just the people doing R&D, like a quality assurance person or a salesperson or an engineer or a software person, but it even includes a level above that person, which is the management or supervision, and the level below, which is administrative or support. So again, we can take wages as far as our calculation of the credit. Number two, we can also take supply costs. And supplies have been a lot of expansion on that. It can include tooling, fixtures, prototypes, first run articles, failures, trial runs, lots of things in the supply category. And then thirdly, we can take contract research or contractors. 1099 miscellaneous individual employees, a company that we might collaborate with or partner with on. So again, these are expenses that companies have expensed, deducted, written off, put on their books and records. And a lot of companies go, okay, well, that's it. I took the deduction and that's my benefit. Well, for every dollar of these expenses that qualify, we also get a credit. And as a rule of thumb, it's about a 10% credit. It's just a rule of thumb, but it'll kind of get you an idea of what the magnitude is. So if we had $1 million of expenses or $500,000 or 200,000, whatever the number is, we also get a credit as well too. And what it does is reduce down the effective tax rate. And especially as we had on the last sort of segment before the break, the tax rates are going up. So the credits are becoming more valuable. I think we're going from 37% to 39 and phasing out and doing some other things. Credits have always been good, but I think they're going to be, probably just even more sought after, I believe, that's out there. So some changes to the R&D credit, the PATH Act, there's been a lot of changes. I'll highlight a few of these. The PATH Act of 2015 made the R&D credit permanent. So, and it's kind of funny that this is out there because the credit's been out since 81, but it was always part of, from 81 to about 2015, it was always part of the extenders program. Extenders, and I'm sure you guys are familiar in the tax world, extenders mean every 18 to 24 a month or 12 to 24 a month, there'd be certain tax provisions that would expire and have to get renewed by Congress. So every 18 to 24 months, we went through this constant battle, and it seems like Congress would never renew it until December 31st of the year, and they'd back it up to the beginning of the year. But anyway, the R&D credit is now permanent, so we can count on it. It's not going to expire. It's not going away. Even in the current administration and the things we're reading about the new administration coming in, there's not one piece of conversation about removing it. Or matter of fact, it's probably going to go up or even be better as we kind of go forward in time. And
I think that's a really good point, Kevin. Currently, under the second relief program that Congress was proposing to pass, they were looking to not only make the R&D potentially double in size, but they were actually making it potentially refundable. So that is legislation that is currently in the Congress, but it's not something that's yet been passed. We foresee there being a second relief after the new president is elected, but we don't know what's going to happen with the R&D credit. And really what made them realize that the credit could be so powerful is how much dependency we have on foreign supply chain. So one of the things that came and surfaced through this pandemic was how much we rely on foreign supply. So Congress wants to bring those jobs back and bring that manufacturing back to the US. So they're looking to make it refundable and potentially double it in size for manufacturing here in the US.
Mm-hmm. Yeah, so again, all the indications that we see, regardless of political party and who might be in respective offices, we're seeing every time we see a change in R&D, it's getting better. And I mentioned that kind of earlier, but one of the other things that the PATH Act did, we call it the AMT turnoff. And a lot of clients had experienced this in years before 16, but what happened was typically with the R&D credit, and a lot of businesses being flow through businesses. So yes, there are C corps out there, but a lot of them being S corps and partnerships and so forth. Well, the credit would flow out the K1 form. We could calculate a credit because the activities were there, the dollars were there, but it would flow out to their return. And from a tax perspective, historically, it would take what's called their regular tax down to, but not below, what's called tentative minimum tax. In other words, it would take their tax down to this minimum level, and you couldn't go below the minimum level. And a lot of times the delta, the difference between the two is very, very short. And they couldn't use the credits. They might calculate a credit, and the credits have a carry forward life. But if, for most companies being in the here and now, if they couldn't, use a credit, they were probably not interested in moving forward. So what good are credits if we can't use them is the point. But with the PATH Act, if you have a company with average gross receipts of less than 50 million, which is their definition of a small business, which are most of the clients that we deal with, we can now take the credit against both regular and alternative minimum tax. In other words, you can drop your taxes almost to zero with this credit. And same activity, same company, same, but with this A&T turnoff, we call it, we can now use credits where we couldn't use them before. So now we can use them against alternative minimum tax. So we have a lot of companies that were previously in the 39.6 or 37% bracket. And again, A&T is maybe 28. But now we have companies that can use the credit and goes below, so we can take them down to the 15% level or the 12% level or 2% level. So this AMT turnoff has been a huge opportunity for companies. Again, pointing back towards Congress wants companies to take this. So they're trying to ease up whatever barriers and rules we might have previously seen. The next thing that the PATH Act did was a startup provision. And again, not only are they rewarding companies below 50 million, but they're also rewarding companies in this startup phase. And they define startup as less than 5 years old of a company, a company less than 5 years in existence and less than 5 million in revenue. So if you're below 5 million in revenues and 5 million in life, you're a startup company. And it sort of falls under our traditional definition of what a startup might mean, kind of an earlier, newer company. But again, these companies typically in the startup phase were not paying tax. I mean, most of the time they're worried about growth and putting every dollar they make back into the business. So there really wasn't a lot of profit, writing off assets, 179. And so startups were really one of those great industries, startup manufacturer, startup software, startup others that really couldn't use the credit. They're not paying tax. So, but what Congress did was allow credits to be used against payroll taxes if you're a startup company. So startup companies may not be paying federal taxes, but they certainly might be paying payroll taxes. So if you have a company that's starting up, again, they may not be interested in credits because they may not understand it. But if you kind of go back and say, well, you are hiring 12 people and your payroll taxes are X, Y, or Z, we can use it against that as well too. So that's been a great, great benefit for companies. And, we've seen a lot of good provisions with that. And the next slide we have is an example of it. A software developer, let's say they have 100,000 in credits that's out there. And quickly to mention, you can go back to 2017 on this. So this isn't from today going forward. The years that are open are 17, 18, 19, which are returns that have been filed, plus the current year 20, which we're about to worry about. But let's say a company had a software developer had 100,000 credits. And again, they're pre-revenue. And again, with software, that's pretty common. They're not going to sell a software that's only half done or half complete. They got to wait till it's complete. So they're putting a lot of effort and dollars in, but no revenues in many cases. And the company has $1.5 million in payroll and pays FICA taxes. Well, again, normally that's where we would stop it and go, okay, well, you didn't pay income tax, but you're paying these FICA, the payroll taxes, Social Security taxes. Now we can use the credits of 100,000 against this payroll tax. So now, instead of paying 114, they're now paying 14, if that makes sense. So they can actually go back and see a monetary benefit out of this. So again, it's a great benefit for companies.
I do want to clarify just something really quick, if it's okay, Kevin. So for the startup, you can only claim it on a current year, on a timely filed return. You cannot amend for the FICA tax credit, but you can amend for the regular R&D credit.
That's exactly right. Yeah, some nuances to that, absolutely. And by the way, we can help out on that. I mean, that's what we do. That's where Estefania and I come in is if you have a client and even one brain cell fires often says, I wonder, or I think, or how's this work, or is this fit? Because everybody's got a different set of facts and circumstances. We're happy to walk through through those exercises. Just say, okay, here's a startup, here's what we think. And we can do some trending and benchmarking on many client examples and kind of come back and say, well, in a similar company, we found X, Y, or Z in credit. So, and then the Tax Cuts and Job Act that we have out there also impacted the credit. The credit didn't change a lot, but the utilization picture changed. We have C Corps, and again, with the new tax rate out there, we can take C Corps, you know, down to what's called the 25-25 rule. We can't take them to zero of tax, but we can take them down to 25% of the excess over 25 grand. Basically, what's going to happen is if a company's a C Corp and profitable, their top rate's 21%, and that's a great rate, but they can drop it even lower to like 6, 7, or 8%. And we have credit carry forwards as well too, so we can use those. So, and then the industries, here's a listing of a lot of the industries that we have and we've worked in. And if you kind of look and see the general categories, we got agricultural, architecture, and Estefania, I'm not sure if you want to kind of talk through some of these here, of our examples, but these are, I would tell you, of all the screens that we have, this one's probably one of the more important ones, and we'd be glad to send this out. But this is kind of, so if you have a client in sheet metal or IT or mobile applications, any of these industries ripe for the credit out there.
It's not intuitive a lot of times that what you're doing would qualify, since it's day-to-day activity that you're taking on. And just to piggyback on what Kevin said earlier with the AMT limitation, for every 10 companies that we would talk to, maybe one would make sense financially at the end of the day. So whether or not you looked at the credit in the past, make sure that you revisit this with Strothman and Company, because there have been so many different changes, and to better understand how it is. From the manufacturing perspective, one of the biggest things is the lack of talent in the industry, and the lack of the workforce across the board. So a lot of things that are happening within the manufacturing realm is how much automation is starting to be done, how much robotics and integration is starting to happen within manufacturing facilities. So anytime that you guys are looking at expanding not only your existing products and processes, but also how you make those products will also qualify you. Another area that we'd love to talk about is software and technology. Just a few years ago, there was some regulatory changes that came out that further defined how internal use software can qualify for companies. So across the board, whether you're a manufacturer, an engineer, a software technology company, if you are investing in your own development of internal use software because you cannot find an off-the-shelf product, or you are building on top of that existing platform and improving the functionality, as Kevin mentioned, to be able to meet your needs and demands for your company and your clients, then it's definitely worth visiting with Strothman and alliantgroup, because there's been some recent changes in how we can actually capture those costs related to it. There's other areas as well, but if you see your industry here, it's definitely worth a discussion to talk a little bit more about how the credit has changed in the recent case law that has come out. Just this year alone, for engineering and architects, there was a major court case that came out called Populous. Populous further defined the way that contracts on a T&M basis could be defined in order to claim the credit. So although you're being paid for the work that you're doing, there's still a potential opportunity for you guys to claim the credit. But overall, don't hesitate to reach out. You'll have our contact information as well. I'd love for Kevin to talk through some of these case studies with you guys, just a little bit more kind of like on the facts, just a couple of handful ones that we've pulled together.
Yeah, on the software side, we'll kind of go through these pretty quickly. I'm not sure, Quinn, where we're at on time. I want to be cognizant of that. But if we look at the software and technology groups, and Stephanie, if you want to kind of advance it through, we'll go through. Here's a $30 million company. You can see some of the bullet points below. $30 million company revenues, and we found about $360,000 in credits. Again, that's $360,000 that they would have otherwise paid in tax, and they can go back and get refunds out of it. But if you look at the activities below, and you can scan through that, these are not, trying to expand the world's knowledge or do things like that. These are normal day-to-day things that they were trying to work on. So, and then we got another software developer. Again, you can kind of see the revenues and the credits, and not insignificant. These are actually very, very, $306,000. It's like somebody walking up and finding 306,000 cash laying there. You're going to jump all over it. It's not the same as doing that, but you're going to feel like it's going to be that way. But again, cloud integration, multiple cloud platforms, we hear a lot of those kind of things. So, again, what these companies consider their day-to-day activities can definitely qualify. An IT company, again, you kind of look through and
this is an important one, I think, to point out, where this IT solutions company is not writing the code or the software that you guys are implementing. Rather, they are making them speak to one another. So they're taking a group of products that are available within your company and they're making them speak to one another. So they're building the architecture, they're building a solution for you. So they might use Microsoft, they might use Oracle, they may use other products already readily available, but they're the ones that are creating the design solution and integrating and having them speak to one another. So if you're an IT solutions company, definitely worth looking at. Again, it's going to come back to how you're being compensated for your efforts by your clients as well. Manufacturing, one of my favorites.
Yep. And so we can look at these again. Manufacturing is a great industry. Again, you can kind of see out there a dust collection system, a furnace that they applied. They're applying design engineering activities as well too. So we can look at those things. And again, if you have any clients in these spaces, we have these case studies available and ready for you guys. So if you ever have a client that might be out there, we can always, send you a copy of this as well too and walk through that. So, okay.
Thank you so much, Ian, Kevin. That was great information. Certainly, if you think that your business qualifies, talk to us. We'll give you everybody's contact information so you can reach out to us, reach out to E or Kevin. Thank you guys so much. That was really helpful.
Thank you. Appreciate
the
opportunity.
So if you guys can stop sharing your screen, we'll get Karen to share hers. So last but certainly not least, we're happy to have Karen Koch with us today. Thank you, Karen, for being here. Karen is a partner with Bedford, and she has a master's in tax, and she has an in-depth understanding of the engineering process. So she is an expert in the area of cost segregation and some other tax saving strategies. She has lectured extensively for industry groups, associations, and she works with CPA firms. And we're happy to have her here today. So she is going to take us to 10 o'clock to wrap things up. So I will hand it over to Karen.
Good morning, Strothman team and all the attendees. I'm delighted to be here this morning. Thanks for attending. You've heard a lot of talk about the recent legislation. We've had a lot of legislation over the last couple of years with the TCJA and the CARES Act, and a lot of these provisions actually really impact what we're doing with cost segregation. So today we just want to talk a little bit about some of the benefits and strategies and how really it's cost seg and beyond. So all of you on this conference probably know a lot about cost segregation already, so we're not going to go into the details. We'll talk a little bit about how some of this recent legislation has impacted some of the applications of cost seg, look at a few case studies and some of the misconceptions. Gwen's done a good job of doing the oversight of a lot of those provisions that especially were started with the Tax Cut and Jobs Act. The big thing is that now bonus depreciation can be applied to acquired property. So if you acquire a building, you go out and buy a building for $1 million, and you do a cost seg study, everything you move to a recovery period of less than 20 years is going to qualify for bonus depreciation. So this was effective 9/28 of 2017. Just had to be a little bit careful if you had purchase sale agreement prior to that time. So we look at a lot of those provisions in there to make sure that if the transaction happened close to that period of time, under the transition rules, you might not qualify for bonus on the acquired property. But what we see nowadays is a lot smaller properties are doing cost seg because of this very provision. So we have a lot of people that are looking at vacation homes, or you spend $250,000 on, you know, a small office or an office condo, you might want to look at whether cost seg can help you. The thing that went away that we talked about for many years is qualified leasehold, the retail and restaurant and property designations, and they were all replaced with a provision called qualified improvement property. So it's a lot of the same, but you know, the lease requirement went away. However, unfortunately, there was a drafting error, and the QIP remained in the legislation at 39 year. So it was really of no benefit as it came into place in January of 2018. So we had to just basically park those costs and left them at 39 year, waiting for a correction of the drafting error. It did eliminate the 2-year NOL carryback, which Gwen talked about, and but now going forward, there's the limitation. In other words, everybody's going to pay a little bit of tax. So the limitation is capped at 80% of income. So let's just talk about QIP a little bit, because there's a lot of misconceptions about it. It's an improvement, it's a spend, it's a capital expenditure to the interior portion of your building. And it has to be a non-residential building, so this doesn't apply to multifamily housing. And it has to be after the building was first placed in service. So this is not from a provision that you had to own the building from the beginning of time, but let's say you acquired the building and you make improvements. You would qualify for QIP because you made those improvements after the building was first placed in service by you or a different taxpayer. Now, it does not apply to the expansion, so a lot of times we get involved where a building is expanded, and at the point they're doing expansion, they also do improvements to their existing building. So you want to be able to separate those costs and identify what is really just related to the expansion and what is really related to the old building that you might be able to apply QIP. It does not apply to structural assets, so any of your load-bearing walls, anytime you're adding columns or reinforcing floor, those kinds of things would not qualify. Anything on the exterior, we run into a lot of questions about rooftop units. Rooftop units do not qualify for QIP. However, some of the mechanics on the interior of the building could possibly qualify for QIP, so you want to be able to separate those costs. And as we previously stated, you cannot claim QIP on improvements that were done by a previous owner. So we parked those assets with the hope that the correction would come, and voila, it did. So it came in the CARES Act, where they corrected now QIP is 15-year straight line, and it is eligible for bonus depreciation. The CARES Act also allowed for a 5-year carryback of an NOL. So what happened in 2018, 2019, and 2020, everybody started to push deductions into these years because you could go back 5 years and pick up dollars, get refunds of taxes that you're paid in previous years. So it became a cash flow opportunity for many business owners out there. And these other provisions that are listed here, we aren't going to touch on those because they're, Gwen has already talked about those. But the one thing that is important related to cost seg is for all the real estate professionals out there, the excess business loss limitation was suspended. And so this became a huge win-win for real estate professionals out there to be able to push some cost seg and some other provisions that create ordinary deductions into these years. So if you think about cost seg as really, it's the foundation, it's where you start. So if you use cost segregation to accelerate depreciation, the economics of it is great. and the benefit far exceeds time value of money, all those good things. So if that's all you did, it was great. You got your money's worth. But if you now use a study and you ask your provider to write a scope in such a way that it's kind of like the gift that keeps on giving, then you want to look at how do we take the detail that's in this study to really manage our real estate. So as you all know, there's never a closed year for cost seg. So basically, if you purchased a building 10 years ago, you can look at a cost seg study today. You get to pretend you did the study 10 years ago. The difference of what you could have, should have taken now gets pushed through the current year, change of accounting method, the deduction flows into 2020. So you can still use the benefits of cost seg on your 2020 tax return as long as you haven't filed your 2020 tax return and it's on extension. So a look back study could be a proactive planning opportunity for you. Also, we have what we call partial asset disposition. So oftentimes when you make improvements or renovations, let's say you do an energy upgrade and you got a warehouse and you're replacing 400 high bay fixtures. You've had the building for 10 years. Well, you still got 29 years of life left on those fixtures. So you want to be able to write those off. So you want the kind of detail in your study where you would know the value of what's the fixture that you're going to throw away. The wiring, the conduit, everything else is still going to stay. Then the other provision that's related to the tangible property regs that goes back to 2014 is if I'm making an improvement, am I repairing it or is it a capital asset? And when we can use the repair provision, it benefits us in multiple ways. Number one, it's a current year deduction. And number two, we're not capitalizing that asset. So if we sell that building down the road, we have no recapture issues. So really use your cost seg study to defend the various provisions that are out there, and the treatment for how you're managing your real estate is really how you want to start looking at the foundation. Here's a chart. You'll get a copy of this. This just kind of outlines what happened under the PATH Act, the Tax Cuts and Job Act, and the CARES Act. So you're looking at a time period from 2015 all the way through March of 2020. And so this is kind of a good summary of some of the major provisions that applied during that period of time related to the management of your real estate. Now, one provision that often gets overlooked, but it actually really complements cost seg, is another ordinary deduction. So the deduction for energy efficient building equipment, which is typically your lighting, HVAC, building envelope, hot water systems, typically they're 39-year assets. So this provision is actually a way for you to write down the 39-year asset, the cost of those assets that qualify for the energy efficient building deduction. Now, to be able to qualify for, you have to have it certified. It has to be signed off by a professional engineer, licensed contractor in that jurisdiction. But it's available for newly constructed or anytime you do a major renovation. So the period of time here is from 2006, January 2006 through the end of 2020. If you've had newly constructed property or if you've done a major energy upgrade, you would want to look at this provision because like cost seg, you can do a look back, go back and get it and run the deduction through on 2020. Now, for primary designers out there, anytime you design a government-owned building, federal, state, or local, the government does not take the deduction or can use the deduction, and the Congress allowed for a provision where they can allocate that deduction to you. So on primary designers, you could go back and amend for 3 years. However, be careful, you have to be able to have the allocation signed off by the government entity. So in other words, there's a form where the government actually allocates that deduction to you. And if they do, it is a huge win for primary designers. Let's look at a few case studies. This is an office building that was acquired in 2019 for $5 million. In 2020, they did some capital improvements of $260,000. And so we kind of evaluated what would be the treatment for all of these. In this case, we moved 15% to a 5-year and 12% to a 15-year. That accelerated depreciation deduction, the catch-up of the 481A adjustment, was about 1.3 million. Now the 260,000, what's the treatment for that? So we talked about routine maintenance, things that could be a repair. In this case, the exterior painting and the roof membrane were actually repairs. So they expensed $99,500 on their 2020 tax return. We found another 15,000 that could be related to 5-year bonus. It was carpet and signage, and then the remainder was capitalized at 39-year. However, of the HVAC assets that we had to capitalize, we were able to write off the old. So the cost of the old for the partial asset disposition was $92,000. So all in, we created deductions of about 1.5 million, which at a 35% tax rate reduced their tax liability in excess of $500,000. So we've talked a lot about NOL here before. There's just a couple of things that I want to point out. If you're generating huge losses in the current year with cost seg and you're looking to carry it back those 5 years, you do have a chance to waive other NOL elections that you made in the past, and you can also waive elections where you elected out of bonus depreciation and you've gone back and collected and you've gone back now with these losses, and now you can apply bonus depreciation to those years. So you can change those elections. And then there was some years where we repatriated some income where we would have had lower tax rates. So you kind of get the good of all of these lookbacks, in that you still get to retain that lower tax rate for the income, foreign income that you brought back in. So here is an illustration that I want to use to point out the importance of how you treat QIP, qualified improvement property. And this is like some of the misconceptions, because people think, oh, if I renovated something, I'm just going to run it all through as QIP. Well, the IRS is looking closely at these, because typically it's not all QIP. And in this case, they spent $1.7 million, and we did a cost seg just on the improvements. They had acquired the building in 2018 and had already done a cost seg in 2018. The renovations for 2020 was where we just, so you design the scope for what you really need. So we just did the scope on the renovations. In this case, you can see there's about 14% that remained in the 39-year bucket. So we moved about 30% to 5-year. There was a little bit of land improvements, and there was about 55% that qualified as QIP. So bottom line, what does this mean? We created a benefit for them in excess of $750,000. Now, what's the difference? What would have happened if you just took QIP and you said, hey, I'm going to take the 1.765 and I'm actually going to run that through as QIP. So 1.6 times the 35, let's say a 35% tax rate, you would have created a deduction of about $617,000. The difference between the $617,000 and the $754,000 is about $130,000. Well, where did this extra benefit come? Because you did the study and you applied the provisions correctly, now we were able to expense a portion of the 1.7. 415,000 qualified as an expense. Did not have to be capitalized, will never be subject to recapture. The assets that we disposed of we actually were able to write off. They had an adjusted basis of 580,000. So you see, you would have left 130,000 of benefit on the table. And let's say you paid 10 to 15,000 to have this strategy done, you still gained 120,000 in benefit for the current year that you ran this through, in this case 2020. So I want to reiterate again, the QIP, there's a lot of misconceptions. Make sure that anything that is structural, anything that's related to an expansion, rooftop HVAC units, the IRS is looking at those all the time. And so you want to make sure that you, carve out some of those things and leave it in 39-year if you really had those kinds of costs. So it's kind of unusual. In fact, we've never seen an improvement property or renovation where all of it qualified for QIP. The excess business losses, if you're a real estate professional, you really want to look at that in 2020 because there's no limitations against taking these losses against other income. There's ability to go back and amend prior year if you've missed it, or to run that through your 3115 correction. So 2020, as you know, the previous speakers, as Gwen alluded to, 2020 is going to be a tough year. Losses are probably going to be big. However, there's a lot of opportunities to be able to apply some of these provisions and take those losses back 5 years to gain some cash flow. And I know Gwen alluded to the fact that they're having some issues on collecting for C Corps. A lot of the pass-through entities, I've seen them coming back through really quickly. And if you file that on the IRS, the 1045 for individuals and the 1136 for corporations, the IRS has 90 days to look at it. And if they send it back just not like we're not going to accept it, then you want to make sure that you have enough time in that 90-day window to be able to make the changes or corrections and get it back to them. And they are still, those forms are going to be faxed to the IRS till the end of December. And then after that, you can go back to your regular filing of your paper or your e-filing of those forms, but they are manning a fax machine, and those phone numbers are online. So we talked about NOL. Let me see if there's anything we missed here. I know we are down to the wire. The one thing, if you are doing an NOL carryback, just, make sure, because you will open those years up. Do you want the IRS looking at any of those years that are closed and out of statute? There can be some tax rate differentials that have to come into account. So as you see, your accountant has a lot of planning, and as Gwen alluded to, they're doing a lot of projections, especially with all the PPP stuff now, and then all these other provisions and from the CARES Act, how that's going to apply. And I'm sure we'll probably get some other legislation here pretty quick that might be attached to the stimulus package. So I will close with this and remind you that all of these provisions out here really require a team approach, whether it's tax expertise, engineering expertise, or legal expertise. It's important to make sure that everybody's around the same table looking at opportunities that are available, because ultimately at the end of the day, your accountant's going to put it on the tax return and make it work for you. So we appreciate being back of house to especially Strothman and many CPA firms that help drive the benefit. So appreciate being with you today. Everybody stay safe and well, and wonderful holidays to you.
Karen, thank you so much. Appreciate that information. Again, that's great information that we can use as some opportunity to make 2020 a little bit brighter with some tax deductions. Okay, polling question number 5, our final polling question is up. So please submit that if you need CPE credit for today. We are just about out of time. I know we've had some individual questions that we have addressed. If you have questions, feel free to follow up with us. Again, you'll get our contact information and all of the materials from today. Thank you so much to Karen, Estef, and Kevin, and Neil and Wayne and Janet on the Strothman side. Thank you guys so much for participating. Thank you everyone for being here today. I do want to tell you about the next Strothman and Company seminar. It's going to be a focus on nonprofit organizations, and it will be on Thursday, January 21st from 8 to 10 a.m. It will be another virtual session, and it will feature keynote speaker Walter Woods, the CEO of the Humana Foundation. And we'll be sending out some information on that as we get closer to that date. So again, thank you all so much for being here today. I hope you learned something that you can use. Give us a call if we can help, and have a great day.